Hi, we're going to talk about substantive procedures. So substantive procedures tend to take two forms, analytical and test of details. And quite frankly, this cycle is great for analytical procedures because it involves things like interest, which can be calculated almost exactly. You can compare cash budgets, right? Because they're investing cash and using cash. You can pretty much take the budget and see if they followed it or not, right? So these analytical tests can tell you quite a lot about whether or not that number is the right number, which is what we're after with substantive tests. And of course, just like other cycles, you can do things like confirmations, right? So in this particular cycle, there's probably going to be a broker and a transfer agent with respect to a lot of investments, and of course the equity portion, right? The company's own stocks. Those require confirmations, right? It's a third party. You send them a letter or an email or whatever you're doing, and you find that information back. Of course, you can vouch for existence or occurrence. You can trace for completeness, just like everything else. You can inspect documents. It's not that different from what you're already doing for other things. On debts, again, super easy to, typically it's super easy to calculate interest expense. It's super easy to see if they're retiring the debt when it's supposed to be retired. You can estimate, this is what I think long-term debt, they have these bonds, they're 30-year bonds. They pay them off in this amount. Is that right? You should be able to calculate things and compare. And tests of details, obviously, you can vouch, you can trace, you can inspect. Capital stock, again, you can make an expectation for what you believe that balance should be, calculate retained earnings, and then see if that's what it is. Obviously, you can do confirmations with third parties. You can get schedules, and you can do inspections, vouching, tracing, all the normal substantive tests. Let's talk about the trouble spots for investments in intangibles. So the valuation assertion is where management might want to do some earnings management and make those financial statements look different. So they may have some permanent impairment that they need to take. In calculating equity method investments, it matters not just what percentage of ownership they have, that matters, but also do they have significant influence. Goodwill may be impaired. That can be hard to tell. Is the value of intangibles right? Right? Some intangibles may not be worth what they're worth anymore. How are they valuing derivatives? What are those derivatives used for? Are they hedges or not? Or investments? What's the fair market of them? That takes almost some kind of an expert to determine the fair market value of hedges, derivatives, I should say. Is there realistic distinctions when they are capitalizing software development? So if they're going to have a patent on software and they're including all their costs for that in it, are the costs that are being thrown in there, is that really part of that, or should those be period costs, or what we would call an expense? Adequate disclosure of restrictions, pledges, or liens related to investment assets. So that goes to the rights and obligations. And you need to understand if they owe something on them. In other words, they're collateral. They can't just sell that. that asset. It's not just theirs to do what they want with. Now, there's an issue with fair value measurements, right? So when you're auditing things, when you're auditing investments, right, they may need to have a fair value assessment, right? So this asset needs to be held on the books at what we call fair value. All right? So who's supposed to do that? Management, right? So as auditors, the main thing that we're auditing for with respect to fair value measurements is management making reasonable assumptions about the fair value, right? It's management's job to value their own assets. We're just auditing management's job. So, is management using acceptable principles? Are they applying them consistently, right? So do they value this asset one way and that asset another way, right? Are they being consistent? Is there documentation that supports what they've come up with? And is the estimation properly disclosed? So you and I aren't doing the estimation of the fair value. You and I are seeing what did management do to estimate the fair value, and we are going to say, is that reasonable? Okay. So there's a three-level hierarchy for fair value that I guess you must have learned in intermediate. I hope you did. Level 1, you get your fair value from quoted market prices, right? So if your client has invested in stock of some other company and they don't have to be consolidated, right? Or use the equity method, it's just they purchase some stock, some Apple stock. Hey, we need to invest in something. We got to keep our cash liquid. We'll just invest in some stocks. And they bought some stock in Apple or something. Well, there's a fair market value for Apple stock, right? Anybody of us can get on the internet and look up the value of Apple stock right now. So that's the most preferred. So level 1, something you can look up its value, right? Things that trade on an exchange. Trades on NASDAQ, trades on NYSE, trades on bond, trades, and again, some investments could be in hedges. So that's going to start making it, or not hedges, but derivatives. So, right, so some commodities, now you're like, okay, yes, there's kind of a market, but not exactly for this, right? You've got something that's similar, but there's not a market for that, right? So you own some West Texas crude deliverable at this time, but there's also some other kind of crude, intermediate crude, that's available, right? So is it similar? You can look and see, are things similar, and get a value based on that. Now, if levels 1 and 2 are not available, that's where you start relying on experts. Okay, there's not an actual market for this investment, but we need to market to fair value. So maybe we'll use net present value somehow, right? So does it make sense what management has decided to do? Keeping in mind that if an actual market base value is available, they need to use that. That's the best thing. All right. So when we come back, we'll start talking about the last few accounts in the cycle.